Hello everyone! As we do every month, we're going to share with you the main insights that can be extracted from our digital top-down methodology. Our method consists of evaluating the attractiveness of European equities with regard to 4 complementary pillars of analysis. The first pillar focuses on the economic momentum in Europe. After reaching an all-time high at the end of June, it's decelerating but remains at a high level. The economic recovery will be strong, with the consensus of economists expecting GDP growth of over 4.7% in 2021 and 4.4% in 2022. This is obviously a buoyant environment for equities in the medium term, especially for its most cyclical components. The second pillar deals with the monetary policy implemented by the ECB. The ECB is very accommodative, and the spectacular rise in inflation is pushing down real rates and supporting the diffusion of a monetary policy that will be maintained for many months to come, even though the US Fed tightened its stance at the last monetary meeting in September. Monetary policy is not without consequences for the third pillar of our analysis, which covers valuations. In a context where interest rates are very low or even negative, the notion of valuation becomes key. The risk premium of the European equity market stands at 6.5%. This is a generous level compared to the historical average of 5% and has not been so attractive since October 2020. A return to this historical average could lead to a 15% re-rating of the European equity market. In addition, European corporate earnings growth is on track. Earnings in 2022 are expected to be 18% above their pre-COVID crisis level. In addition, the earnings momentum remains strong. Finally, the fourth pillar deals with the behavioral aspect. The momentum is bullish insofar as all international equity indices, with the exception of China and US mid-cap, are above their 200-day moving average. The European indices, after having logically stumbled on the historical highs of year 2000, could move forward once the powerful supports are reached. The latter are between 3% and 6% below the current level. In conclusion, the environment is generally favorable for European equities. They remain strategically unavoidable in an asset allocation. The economic momentum remains strong. The central bank is flooding the financial system with liquidity, and low interest rates justify a deep revaluation. And finally, market dynamics remain bullish, even if the short-term dimension is more neutral after the sharp rise observed since March 2020. Each correction in the indices should be seen in this context as an opportunity to increase exposure to European equities. Thank you, and see you next month for a new monthly video by Shaheen Capital.